Mr. Shah, good morning. Thank you for joining us. The outperformance which Indian markets have registered is extraordinary. What is leading to this outperformance? Are markets now getting slightly carried away because of complacency and because of liquidity, or you think the outperformance is here to stay?
Hi, Nikunj. Very good morning to you and your viewers. I think there's a saying that either you can get a good news or good price, and very clearly we've seen both sides in a matter of 18 months. So March 2020 we didn't have an iota of good news if you were to go to that extreme, but we had actually bluest of the blue chips also available at a reasonable price, but a lot of market was available cheap. Today, yes, the economy is healing, things are getting better. Some of the sectors actually surprised us significantly in terms of profitability and cash flows, even in the COVID year. And net, if we look back, I think the impact of the pandemic on the businesses, especially the strong businesses, was not as much. And to that extent, the markets sort of, going other side of the spectrum, where pockets of the market definitely are expensive. We also sort of get worried on the pricings at which IPOs are coming through. So yeah, that part of the market looks a little bit of, as you rightly said, people are getting a little greedy, or there is some sort of a euphoric valuations we are seeing in the consumer-facing businesses or in services businesses and the tech companies that we are looking at. Having said that, there's also an opportunity to do a little bit of bottom-up stock picking, because as the important point is the economy is healing, there will be pockets of the economy which will emerge and get better. We are coming out of a very, very difficult times of the economy, not only last 2 years, but even last 4 or 5 years, we had one shock after another which set back the economy. So I think there is an opportunity to do some stock picking here.
Since you run a mutual fund which is public money, most of the mutual funds normally run a mandate of, by and large, they want to be invested. The cash levels may be 5%, 6%, and again that's extreme. So in this market, how are you ensuring that you avoid the greed and yet you are able to generate positive returns?
Yeah, the way we see it, there are asset allocation products where we would take equity and debt calls, and to that extent, in our asset allocation products, you would have lower equity and higher fixed income at this point of time. But especially, as you rightly said, in the equity funds, the mandate is to stay invested, because the asset allocation is done by investor or the advisor of the investor. One of the two or both of them put together has done some sort of asset allocation. That's our understanding, and that's when they give us money into our equity funds, the mandate for us is to stay invested. Secondly, as I said, all is not gloom and doom. To be very honest, today, as I was saying, we are seeing pockets of the market. If you look at manufacturing, now that sector has been on and off, but struggling for most of the last decade. You had our own problems of high debt, or you had problems of deflation being exported out of China, where the overcapacities lead to some manufacturing or most of the manufacturing having very low profits and low return on equity. So that sector has almost got off the radar of the investors. Infrastructure, that's another space where, again, while government has been continuously spending, the private sector capex was practically absent or very little in last 10 years. As I see today, we're looking at manufacturing doing very well, profitability is picking up. On top of it, there are capacity expansions being announced. So we are seeing some green shoots as far as private sector capex is also concerned. Construction, real estate is always a big driver of jobs and big driver of economy. given there's a lot of indirect employment also that comes from construction. So that again, real estate picking up, especially the residential real estate in pockets of the market as jobs come back, IT salaries are doing very well. So if you ask me, we are finding that there is a room to go a little deeper into the economy, deeper into the markets, and see where the valuations are still reasonable, growth prospects are improving. And that's what we've been doing in our portfolios also, where we actually, if you ask today, we have more manufacturing, a little bit of more infra in the portfolio than what otherwise we would have had. Also within services, we are looking at services which are more dependent on recovery, like banking. Within banking, we are looking at more corporate-oriented banks which are dependent on recovery of corporates and the profitability of corporates.
That's right. If I see your portfolio, you've got Axis Bank and SBI right there in the top 10. Mr. Shah, the other thing I noticed, because you're talking about the comeback of the capex cycle, one way to look at it is after almost a lost decade. And from your top holdings, are you doing it indirectly, for example, and talking about manufacturing with steel? Your exposure to Tata Steel, SAIL is also there. You talked about recovery in real estate, but that's not there. So are you doing that? Are you playing that indirectly?
Yeah, so some of the manufacturing is also benefiting from global macros. And to that extent, our large weightages are in the sectors which are benefiting from global macros as well as local macros. And obviously, steel is being part of it. Textiles is another area where, again, we are benefiting from India's competitiveness in that sector, while China is sort of withdrawing from the exports market, in particularly steel. Both works very well. Yes, we do like residential real estate. That is part of the portfolio. We also very keenly looking at private sector capex drivers. We have more consumables in private sector and some of the capital goods play also in our portfolio. So yeah, it's fairly early. It's too early to call for a complete revival for private sector capex. That's why I was saying there's still green shoots. So we are watching that space. What I was trying to say is, there is valuations issue, but it's in the pocket. It's in the P2C businesses, consumer-facing businesses, part of the services industries, which again is a high return on equity, low capital-intensive businesses. This have been sort of a mantra in the market for last decade, where if you have a high return on equity and low capital intensity, people have given you 50, 60, 70, 80 Ps. Some of them are not making money, still they're getting very high valuations. But these are the so-called old economy companies, but they're coming out of a lost decade, as you rightly said, as China reduces its focus on manufacturing and it reduces the deflation it has been exporting into manufacturing industry globally.
And when you talk about wage inflation, the IT sector's fantastic growth and consumption, how will that be reflected in the portfolio? In 2018, you had taken Asian Paints, and I'm seeing previous price actions that had been taken. But if I were to look at your top 10, consumption is absent. I mean, discretionary consumption.
Indeed, I think both discretionary and non-discretionary, as I was saying, particularly in our contra portfolio, we've been very clearly avoiding them. It's basically priced to the perfection. If you ask me, at times we are finding it too expensive. No doubt the prospects look good. No doubt the per capita in India will continue to rise to that extent. Some of the consumption, parts of the economy will continue to do well. We are also seeing some consolidation happening in some of those areas. So I'm not denying that the prospects for the consumption sector and the consumer non-durables is not great. It's just that the valuations is something which is not attractive at this point of time when I look at risk reward in investing in that sector.
Anand, is there any pocket where you worry about the valuations to a higher degree aside from what you just reiterated, wherein you feel that there is a bubble in the making or a lot of froth already at the top?
I think more than sector, I think what I find and little worrying is the prices at which the IPOs are coming in. To be very honest, even in the IPOs in the old economy sector also, where like to like I can compare with the listed space versus unlisted, we are finding at times the valuations are actually far more expensive in IPO, which otherwise should have been at a discount that, given that the company doesn't have a history and the track record uh, in the listed space. I think that's little aberration. So one part of the market we've been sort of being very looking through a fine lens and have sort of avoided most of it is IPOs. That's something which retail investors should be conscious of before they look at it as a flip opportunity. Second is the new tech, as we keep on talking about the disruptors. Again, these are the businesses which don't have cash flows. These are the businesses which have large losses, but nevertheless they have built a lot of consumer franchise for themselves. Again, this is another segment of the market which we are trying to understand more. We're trying to see how do we, because the traditional valuation metrics that would apply otherwise, the free cash flows, the discounted cash flow methodology, those are the things are very difficult to deploy at this point of time, given they still would have another 3 to 4 to 5 years of negative free cash flows and more equity gains in the offing. So that's another space where, again, we are not fully comfortable yet, but we're still evaluating that sector.
Quite interesting. So have you completely missed out on the new age tech IPOs, which have got the market frenzy, and clearly the word valuation doesn't seem like an apt method to try and ascribe any metrics to the way these stocks have been quoting?
I would not say miss out. We have avoided, and we have a very, as I said, the key philosophy that we follow is identifying strong businesses which have a lot of moat, sustainable competitive advantage, a very good path of the growth. So we are continuously looking for opportunities in growth and high moat businesses. So we are fully invested. We have been participating in all these markets very well. This is one area which we have, because we are not able to understand the valuations at this point of time, we have not participated in that consciously.
You know, at the start of this interview, you said you can't get good price and good news together. We were also discussing how this is perhaps not the time to be greedy. In a sense, does that also mean it's going to become the return of the cyclicals, the safer bet?
Again, to me personally, again, there was a discussion that what if you end up buying stocks expensive? That is a lesser of a problem. To me personally, the healing economy, the economic recovery, not only from the COVID-1 and COVID-2 wave 2 shocks, but even from DMO and GST implementation led disruption, or the NBFC crisis led consumption slowdown. I think we are talking of almost 4 to 5 years of some sort of a disruption and slowdown in the economy. It was not only last 2 years. To that extent, our take is, and given that there's a huge fiscal stimulus which has come through last year and this year, we feel fairly confident that the economy is recovering well. We might have the China plus one PLI related manufacturing capex coming back, can also further sustain this growth for a while. So, as I said, there is good news. Maybe the valuations is a challenge. One needs to look through them. I mean, it's a lesser of a problem, or a better problem to have is the valuations problem than to have a business problem. So today, let me reiterate, I think the economy is looking good, businesses can do well, environment is right. Now, within that, what can you identify which is reasonably priced? I think that is the job me and my team have. And that's where I was saying that while there is an issue of valuations in pocket of the markets, and we have been sort of evaluating or avoiding at this point of time, very clearly, you call it cyclicals, I call it high moat manufacturing businesses. Even within manufacturing, you can have companies with a very, very strong franchise, strong sustainable competitive advantage. We are looking at steel, textiles being two of them where India has a right to win. And within that, we have leading companies in our portfolio which has further right to win within the Indian steel sector and textile sector. So, and the valuations are reasonable. So, as I said, there is good news at the macro level, and to that extent, we have valuations issue at the macro level. But that is when the expertise of looking deep into various sectors, identifying companies, and find out something which is having good growth prospects, have sustainable growth prospects at the same time as reasonably priced. I think that is what we have job at hand, and we believe we have been able to do it so far. So to add to another question is, do we need to raise a lot of cash? Do we don't find any ideas in the marketplace? I think that's something which is not a problem today. We are finding enough and more ideas to participate in this healing economy.
Just to wrap it up, how exactly do you think one should understand what is happening in China? We can look in India in isolation and say what's happening in China is local, what's happening to Chinese internet companies does not change my life, what will happen to the Chinese norms in terms of manufacturing or ESG, it does not change us. But if the second largest economy in the world is going through a change and a massive change, it will have impact on just about every major global looking sector. How are you factoring that big unknown in your entire template?
Indeed, I don't think we can ignore that. It is an important macro factor at this point of time. But what we have been doing all along, even in GFC time, we looked at what is the impact of global financial crisis on individual sectors in India and then individual companies in India, and whether they have balance sheet strength, whether they have management depth to survive that, if any. And if you can remember, not a lot of companies and sectors were severely impacted while the markets had corrected. But some of them which were significantly leveraged had a significant pain, and some of them didn't come back. So I think we continue to evaluate. China is the largest consumer of commodities, particularly metals. In most of the metals, it consumes more than 50% of the global consumption. And to that extent, that is one sector which we are evaluating and saying, what does it mean? Because parallelly, while it will lead to a lower consumption as the real estate market slows down in China. You also need to be cognizant that China has also embarked upon decarbonization of their economy. They want lower CO2 emissions, and that also they have been following with a very, very strict, implementation. To that extent, there will be lower production of most of the commodities, particularly metals in China. At the same time, there will be lower consumption, and we need to evaluate that. What does it mean for the global metal prices? And then we come down to India. What does it mean for the Indian metal prices and Indian metal companies? You would have seen a lot of volatility in the near term because of that. So we've been evaluating all of those stuff where it can impact individual sectors and companies in this country. Notwithstanding that it can have a negative impact on the overall market, which is volatility. To be very honest, the moment you invest into equity markets, one needs to sign up for volatility. We cannot say at any point of time that market will not either go up or go down. To that extent, we are not too perturbed with the volatility it will inflict on the broader markets, but we would be more perturbed about the risks it will open up for individual companies. So we are more conscious of the risks involved because of what's happening in China. And there we see far and few companies in India which will be terminally impacted because of this. But as far as volatility is concerned, I think that is something which is part and parcel of the equity markets.
Anand Shah, we're going to leave it at that. Thank you so much for joining us today live on the market. Let's take a short commercial break. We'll be back in 2 minutes.